Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. And today we're going to look at chapter number 8, which is about inventory. And more specifically, I want to look at multiple choice question number 3. So if you have a moment, you may want to go read that question and see what it talks about, and then we're going to answer it together. But it's basically a cost of goods sold question. The company has information. It appears that they're using a periodic system. The way I know they're using a periodic system is they're keeping a separate cost for the purchases and a separate cost for the transportation cost. So I'm assuming they're using a periodic system. So we're going to compute cost of goods sold this way. We're going to take the beginning inventory, and to that figure, we're going to add what they purchase. Now, in the purchases, they actually have two costs. They have the acquisition cost, what it costs them to buy the inventory, acquisition cost, and also, as you can see, they have a transportation cost. So we're going to include both of those costs as part of the overall cost of their inventory. And that will give us whatever the goods are that are available. So if they did not sell any inventory at all, they would still have the goods available for sale. But of course, they have some sales. And at the end of the year, then, we're going to subtract, take out, whatever is left, the ending inventory. And of course, what you're going to have then is the difference between what's available and the ending inventory is the goods that you are missing. But in accounting, when we're using a periodic system, anything that's missing, we simply assume is part of the cost of goods sold. So we now know the formula. So let's put the numbers in. They begin the year, as you can see, with inventory of $490,000. That's what they have in stock on the very first day of the year. During the year, they purchased another $1,060,000. So we'll put this here. They purchased $1,060,000. But they also had to pay another $30,000 in order to get that inventory delivered to them. It was considered to be a normal and necessary cost to get the inventory into position and condition to be sold. So how much is the total cost of that inventory they bought this year? Well, it's $1,090,000. The $1,060,000 that they paid for it and the $30,000 that they paid to have it delivered to them. So how much inventory do they have available? They have $1,580,000 in inventory. If they don't sell any inventory at all and they don't lose any, then they will have $1,580,000 in inventory. However, the end of the year, they go out and take a physical count. And when they take the physical count, they discover there's $450,000 that remains. They had $1,050,000. They now have $450,000. What then will we ask happened to the other $1,130,000? We make the assumption that that missing inventory, that $1,130,000, is the cost of goods sold for this year. That's how, when you're using a periodic system, companies determine their cost of goods sold. So therefore, if you look at the multiple choice questions, the answer to this question is D. Now, you can do this. It takes a little practice, have to think about it, but there's absolutely no reason that you can't work this question and that you cannot use this information to go on and do well in financial accounting. Good luck.